Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager, due diligence, or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we'll have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager Niels Kostrup Larsen.
You're listening to Top Traders Unplugged, episode number 028, where I continue my conversation with Scott Foster, founder and president of Dominion Capital Management.
So that kind of is a long way of answering the question of how do we staff our company and why do we do things the way that we do.
But that was a very important explanation, and it ties into so many other things. And I want to go further than this. But I want to actually ask you a question that actually doesn't relate to short-term trading.
Sure.
But it's my kind of trying to understand what it is you're saying and putting into a slightly different perspective, and that's relates to more generally speaking about trend following. Because obviously, as we know, you mentioned 1994, and I remember seeing, all the great guys sitting lined up at a conference in Chicago and talking, about a very difficult period. But they were convinced that this was just, a difficult period and things would come back. But let me ask you this: trends in markets in general, not necessarily short term, but just generally, is that kind of based on universal truth? Because at the end of the day, trends reflect human behavior, and human behavior will never change. And what we're seeing now then, where perhaps there have been a lack of trends for a period of time, is just part of, a normal cycle.
Absolutely. I often express my, I don't say unhappiness, but I think trend followers could do a much better job of explaining what they're doing. Everybody seems to want to be a scientist, and nothing wrong with that. It's just that I gave a talk a few years ago in Monaco on this about the difference between what we would call black box and what I would call white box, and I was trying to make a differentiation between some forms of systematic trading and some forms of systematic / algorithmic trading. And the fact that the vast majority of of people outside that are in the alternative industry won't invest in systematic strategies because they don't feel like they have the expertise to understand them or the mathematical skills to. And I was trying to make a case that, well, as it pertains to the vast majority of managed futures, they're not black box. And the reason being is, what are they going after? And I tried to make a case that they're going after a universal. When you ask a trend follower, why do you make money? If they start talking about formulas and all this type of stuff, the question is, well, they're really the only way they can make money is if they're trends. And the question is, well, why are there trends, and why ought there to be trends in the future? And a trend follower, when asked, why are you going to make money in the future? I think they should respond, because trends cannot not exist. Yeah. And the question, and what exactly in particular does that mean? Well, it's what you said. It's the fact that, at least in a free society, markets exist to create efficiencies for the greater good. And if the price of wheat, if we start running out of wheat, the price has to go higher it has to ration the remaining supply. It has to ration the remaining demand. It has to increase the supply. It has to incentivize people to plant more wheat because we're running out of it. And if we didn't have, futures markets were created for that purpose, and without them, the prices of food would be fluctuating all over the place. But at the end of the day, there are inefficiencies that you can arb out of the market, and there are inefficiencies that you can't arb out of a market. The ones you can't arb out of a market are natural law inefficiencies, or universals, as you've called them and I've called them. And trends are one of them. If you're running out of wheat, you can't arb that the price is going higher,
Sure.
and nobody can stop it unless the government steps in and subsidizes something or gets in the way of it. The market will go where it needs to go until there is an equilibrium between the buyers and the sellers. So in theory, and this is Austrian theory, that trends are necessary. I mean, there are short time periods, and this is what's hard to explain to people who are following trend followers around, because usually the time periods of equilibrium are not as long as they have been. And so there are times when trend followers, they're just, some of the markets just randomly they happen to be fairly valued, and nothing changes that in the future. But unless, we become perfect prognosticators, and exactly how much of any given commodity is going to be needed, a year from now, and exactly how much supply to create to meet that need, which nobody can know that. I mean, we've tried command economies, it doesn't work. There's no way to plan. The socialist calculation debate has completely devastated the idea of central planning, because you don't know. The trend will tell you what to do. The trend will tell you whether you need more wheat or you need more copper or you need more of, or whatever you have, until there's an equal amount so that everybody's needs are served. So right now, it's, I think it's pretty obvious at this point to everybody that the Federal Reserve and government intrusion in the marketplace, particularly through suppression of interest rates, has been devastating for price discovery in pretty much all freely traded markets. They're not allowed to go. I mean, when you control the price of money, you control the price of everything. And when there is a threat of constant intervention through regulation, taxation, and nobody really knows, because the government and the Federal Reserve don't know where they're going with this. They pretend they do, but they don't. And most businessmen know they don't know, and there's no exit strategy. And so it's created incredible suppression of price trends, and it's created volatility with no direction. It's created it's wreaked havoc on the markets. But eventually, if you look at it and say, what is this ultimately? This is ultimately a price control. Right. And price controls ultimately create the exact opposite of their intended effect. Yeah. The question is, how long is it going to take? The markets will eventually, they'll go crazy. I mean, they're going to go to where they need to go, where they have not been allowed to go. And hopefully that won't be too far in the future, so that, the business is still around and exists to take advantage of it. But I think it's probably closer than it's been, but I probably would have said that a year ago. Sure. But I think it's a certainty. It's just a question of how long can the government and global governments keep this illusion up. Because right now, as we mentioned earlier, the perception is based upon, spreads, yields on junk. There is no risk. Yeah. Lowest volatility levels in fixed income, foreign exchange ever. Stock market just a month ago had finished 40 straight days without moving a percent, which it hadn't done in over 20 years. The market is not pricing any risk into the situation, which is irrational, but that's the way irrationality can last longer than a lot of firms can stay solvent. So back to the magic, the perception is there is no risk. Yeah, exactly. I mean, it's very interesting, but let me ask you this. Well, first of all, let me just say that I can imagine with the explanation you gave about, philosophy and universal truth, that there aren't that much room in a normal due diligence questionnaire to fill out the box where it says, I believe in universal truth as one of my founding principles. So, but let me ask you then this question. If that's the case, and this is the way you develop models, which is quite different from most other managers, is your model decay, which a lot of short-term managers is saying that there is model decay in the way they trade, and maybe a model lasts 2 years. But is my understanding correct then that in fact you don't really see that as such, or at least not to the same extent? That's true. Model decay is not generally something that I worry about. For me, for a model that starts to underperform what it has in the past, we tend to be a lot more qualitative about that. To give you an example of how one of our models might decay as opposed to how somebody else's models, because again, we're not looking at parameters in our models are not numbers with lots of decimal places to the right. They're mostly binary switches. If this happens, we do this. If this happens, we do this. If this happens, we do this, because it's much more qualitative. It's almost like how a discretionary trader would trade a 2 or 3 day move in the marketplace based upon how he would feel like he's reacting to a bunch of other traders that are doing something.
Yeah.
The decay would be something that is more tied to the structure of the market and have very little to do with parameter sets or other things. Like, for example, years ago, quite a long time ago, we had some models that were trading off where the opening price was. Mm-hmm. And back at that time period, and for many years prior to that, there was a real psychology about a gap.
Right.
And a lot of people have written about it. Will the gap be closed? Will this happen? And so forth. And I had some models that I thought that there was a reason why there would be, under certain conditions, overreaction on the open.
Right.
And then I would go against that. It was part of, it was part of our reversion strategies repertoires, and it tied out to this particular psychology of what was going on here. And over time, that model started to deteriorate. Mm-hmm. And you get to a point where, you're always reviewing performance everywhere, like, okay, what's going on here? And then the light bulb goes off. Well, as electronic trading and off hours and Globex started to become more and more prevalent, and as more people in Europe and Asia were having access to the same or similar markets, risk was being able to be transferred more effectively around the clock.
Right.
So the pent-up demand on the open was slowly diminishing. I mean, there still is some, but it's usually retail people executing on the open while the professionals pull all their orders and they create the big zigzag in the first 10 minutes. But it's not. It's a different character than it used to have. And so, when we understand this is the psychology that we're doing, we're tying this out to this one principle. But the market structure itself is no longer offering us the opportunity to utilize that principle in this construct. Then we make an adjustment to it, which is not as that type of thing isn't happening. It's not like all of our different models. We think that every day they're slightly deteriorating by 0.01%, and then it's always a clock that we have to. And I don't think of that way at all. As a matter of fact, I can nothing is more surprising to me when I dust off a model that I haven't even touched in 15 years, and it's at new equity highs. It's just it's one of those things that that makes you feel great. Most of the times that I can track back to underperformance or poor performance for any stretch of time rarely can be tied to a bad parameter set. Usually it's tied to a principle that wasn't fully tied out, or even worse, which is you're always balancing, trying to make decisions about things, but one of the biggest risks is changing anything about your models. Because you can have incredible slippage. You stop trading one model because it's doing poorly, and then you add one that's doing well, but then all of a sudden the one that you just dumped has a huge recovery and the one you got in does poorly. And all you have to do is do that a couple times in succession, and you're looking at double your max drawdown and all your clients are going away. So the way, a process by which you implement changes is as important as the changes themselves. But a big part of that is understanding what's driving the changes, because things that are coming from a universal are a lot different than things that are coming from the particulars, in my opinion, anyway.
It's quite interesting because obviously one of the changes that you made, you said early on, was caused by the introduction of the euro, and so you could say that the markets or the opportunities set changed. It wasn't so much human behavior that changed, just the fact that there were fewer markets, but it's interesting to note that, you've actually done really, really well in the last few years at a time where many people haven't done so well, first of all, but also at a time where you could actually argue that, as you mentioned, markets have been somewhat influenced by other factors than normal free behavior because of the actions of the Fed and the other central banks. So it's just, I don't know whether it means anything, but it's just an interesting observation when I look at your track record that, even in a situation where human behavior may not be so freely expressed, given these constraints, that, your models have seemed to cope with that very well.
Well, we've been able, it's been a difficult environment. We were doing, we had a bad year in 2010, but prior to that, even with some of the chaos going on, we were doing better than the indices and averages. And I was very comfortable with what we had built in 2000. It was like a 2-year project to build the Sapphire program. And it was a lot about having a different way to allocate to markets and having a different way of approaching portfolio but having all those elements tie back, prior to that, like in the global financial, I was operating under some of these psychological principles for the individual trading, but my portfolio construction, my allocation, my risk had nothing to do with the psychology. It was not integrated. It wasn't tied to a universal. It was not, and ultimately you end up paying the price because you don't realize what you're, until it starts to hurt you. You don't realize that you're doing something that you didn't have a reason for doing it.
Right.
I mean, you just took the status quo, or you just thought, well, I'll just do X. And so I knew that we needed some different markets, additional markets in the portfolio, but I also knew that we needed to have an allocation scheme that was different. And so, and philosophically, it's kind of like, when I lived in Chicago and had friends down on the floor, if they were, trading soybeans and the soybeans were dead, they'd walk over and start trading bonds.
Sure.
To be opportunistic and realizing that just because we're focusing on these emotional things, there are times where a market is clearly telling you this market is not particularly subject to those types of emotional movements because it's in a state of equilibrium. Nobody is, and then if something does happen to jolt it out of equilibrium, then it may enter into a type of environment where it's expressing these characteristics that we specifically are looking for. And so we've learned to become extremely, we always were a low volume trader, but over the years we've become even more low volume. Like, for example, the last 5, 6, 7 years we've averaged about 1,700 round turns per million. That's as you know, incredibly low for short-term
trading. Yeah.
And some are, I think the average would probably be closer to 5,000 or 6,000, but there's a lot of traders that are doing 10 to 15,000 round turns.
But that, to me, that sounds a little bit like, in a sense, that you're filtering out the markets that where essentially there are no opportunities, or as you say, they're in equilibrium. But I want you to try and kind of explain that, from a system design point of view. How do you get to that point? Because at the end of the day, we need to bridge the gap between philosophy and coding or rules. Right. And so how do we do that? How does it actually work when you look at your program and the structure and doing all of this in practice?
The way it works for us, and again, it's we do a lot of things that I guess some of them I'm very comfortable in sharing, only because a lot of them just don't have any application to other people's strategies.
Sure.
Because of what drives them. You could implement some things, but the driver behind it is really what makes it work or not work. In creating the program, the Sapphire program, it took a long time to create it, and that's kind of why there's a longer, flatter time period than I would have liked to have had in the early 2000s and in transition. And there are a variety of reasons for that, but the biggest one was my main programmer at the time left.
Sure.
His wife was from Puerto Rico and was not particularly thrilled with living in northern Michigan. So she wanted to head to where the sun was, and I understood. But the reprogramming, I'm trying to do some very unusual things in terms of how you go about allocating, rather than just saying, here's the portfolio. It's how do you make it dynamic by using principles, and how do you quantify things and what can be quantified? And I get asked questions like this often when they say, well, you've listed a whole slew of qualitative things. How do you get from qualitative to quantitative? How can you ever systematize half these things you're talking about into something objective that resembles this? It's like trying to get someone to quantify, how happy are you? Is it a 6 or a 7 or a 9? It's very, very difficult to do that. And so how do you go about, how do you make that transition? Well, for allocation purposes, we look at it in the sense that we believe that in terms of what I was just talking about the environments, it's just not like, okay, this is a good environment, this is a bad environment. Things don't, because the environments for us that are constructive are ones in which a market is, for lack of a better term, it's emotionally charged. There are a lot of people with strong opinions and a lot of vested interest if the market moves too much one way or the other. And so everybody is on pins and needles watching this thing, right. And they're concerned about which way it's going to go. And there's some uncertainty about it. So there's a real need to, transfer risk. And that's obvious because what the market will do when that happens, and everybody knows this, is volatility tends to increase. And the increase in volatility is, starting to tell you that something is very interesting. Now, the interesting thing about volatility, however, is that volatility is both very persistent and yet mean reverting.
Sure.
And that's simply because volatility, as we know it, generally is associated with uncertainty. And the only thing that's uncertain are people's perceptions of things. And people's perceptions don't, unless you have, some type of significant illness, you don't get really happy one minute and really sad the next, and really happy the next minute and sad. You transition. I mean, volatility in markets tends to trend higher over months, and it trends low over months as people are constantly reassessing and figuring out what's going on and becoming comfortable with what's going on, or that whatever is going on is resolving itself. And so volatility doesn't spike one month in crude oil and then drop the next month and spike one month and drop. It trends higher and trends lower. Yet it also mean reverts because there are limits on high and low volatility. This, is not just simply looking at past history. I mean, intuitively, if volatility is tied to human behavior, that's what you would expect it to be. I mean, your human behavior and emotion, tends to go from very sedate to there's a certain amount of excitability that you can pretty much maximum express, and you're going to bounce back and forth in between those, and it's going to trend up and trend down and so forth. So if that's true, if that is the nature of, and most people won't debate with me about that simply because empirically it can be shown to be true so easily.
Sure.
But there's for me, and there's got to be a reason behind that, not just because that's what the data says, but. If that's true, then we generally know that we're very streaky in our trading. That when a market comes into play, we may make money in a particular market for 3, 4, 5 months in a row, and then if whatever conflicts that are erupting in that market become to be resolved, and there's less of an emotional footprint in that market, it usually corresponds with a pattern of volatility. So for us, we're very certain of this persistence in our performance because of human nature.
Right.
It's not because we've gone back and looked and said, gee, this is really interesting. We tend to make money 3 months in a row, and then we lose for 2, and then we make it for 6, and then we lose for 4, and then we know why it happens. But if something is persistent, it's an inefficiency, it's exploitable. And if it's a natural law inefficiency, it can't be arbed away, so we can exploit it without having a negative impact on our trading. And so we exploit it by, as we lose money as a market becomes more less emotional,
right,
and so forth. And so as we lose money in an individual model or market, it goes into a deleveraging phase, and we start taking money off the table. I'm a blackjack player, and I used to get have a lot of fun counting cards and doing a lot of stuff, basically what your money management is that you want to keep a minimum bet on the table until the odds are in your favor, and then you want to take the rubber band off the bankroll. Well, we know that when this footprint is starting to deteriorate in the marketplace for us, it's going to be persistent, and so we feel very comfortable deallocating to that model/market as that's happening. Now, if something intervenes suddenly and comes in and hits that market and makes it excitable again, some new fundamental or something or whatever it is, every winning trade from there will reallocate it back up until it gets back up to a full allocation scheme. This is something that'd be difficult for a trend follower to do, even though they're operating off of a solid principle. And I believe firmly in trend following.
Sure.
I designed my own systems, traded with my own money. I worked for a firm and all that. But in trend following, because the nature of your winning percentage and your payoff and so forth, it's very, very difficult to keep deallocating to a market and then possibly miss the one huge trade.
Yeah.
Where you deallocated. But that is not something that I have to worry about.
Yeah.
It doesn't, there's very, very little slippage in my doing that. Well, the benefit there are bigger benefits to this type of money management scheme of being opportunistic, where, for a while, some markets can just get quiet and not cooperate. And yeah, it's great to be deallocated to them for a while. But the more important aspect to it is that you don't end up having all the post-dictive errors in portfolio construction and in adjustments to your models. And this was like the bigger reason philosophically of why I went in this direction. We all know that, now everybody, listen to CNBC, anybody who's putting together any kind of portfolio has gold and silver and this and that and the other thing. Well, 10 years ago, before the bull market started, nobody did.
Right.
If this is all post-dictive, it's very easy as a trader to design a portfolio simply because it's the one that worked best in the past.
Yeah.
But if you were putting together a portfolio in, say, 1982, what would it look like? Well, stock indices were to start trading a few months later, we just got a couple bond contracts. We don't have a lot of, there's almost no international exposure. The question is, how do you get from 1982 to yesterday?
Right.
What is the process by which you would have kept changing that portfolio? So it's not someday you just walk in and say, you know what, we've got to add 40 foreign markets, or hey, you know what, we need stock indices, or we need, any of these new markets, or how do we put the portfolio together? So I tried to envision a process by which that could actually take place. In other words, if you start this portfolio at this date, how would it naturally walk forward in a, I guess you could call it a systematic way, but I look at it more as a principally driven way, so that you're not subjecting yourself to making post-dictive errors where you have a bias against some market, and after a while it's like it's been making money and you're not trading it, so you throw it in right at the top, and then it starts losing money. I remember vividly because, like I said, back in the first days of Dominion, I had no thought out process of allocation to the markets and the sectors, or even to risk. And it's 94, and I start trading the British pound, and I start, I'm losing, and we're raising money, and I'm losing more. And I think I got up to, I don't know what it was, 18, 20, $25 million in losses in just cable. And I'm banging my head against the wall, and I'm thinking, you know what, maybe something's changed in this market. Maybe after the great realignment of 92, when
Sure.
Soros, and maybe there's something here. I don't know. And often at times when a market doesn't behave in the way that you're accustomed to it behaving, you can figure out what it is down the road, but you've lost a lot of money in the process. But then as a trader, having done it so many times before, if you suddenly pull it out of the portfolio, it's going to go on a tear. And so you're in this conundrum. What do I do? Do I leave it? Do I do, and it really toys with you when you have disappointing things, different disappointing instruments and disappointing particular models in certain instruments. And you don't know, am I just going to keep trading this and lose money forever? Or is there something, in this market that's different, or is this just a regular drawdown? So when we build our portfolio, it walks forward and it automatically handles that. So if a market were to turn, to be a horrible trading market for 5 years in a row, our models would have it deallocated down to a certain level, and then it drops out of our portfolio and goes into just a simulation basket until it improves enough to be worthy to go back in, meaning until it comes back in play and people are interested in transferring risk in this market, and it has those characteristics. So a market can be out of the portfolio for years, where you're happy that it is out of the portfolio. And I'll give you an example, like, I don't know when it was. What was it, 2008 maybe, or 9? I can't remember when all of a sudden the sugar market got really exciting. And sugar had been out of the portfolio, I'm not even sure if we traded it ever in the Sapphire program, but all of a sudden, the model says, hey, take a look at this. People in this market are really, this is showing all the signs of an emotional market. And all of a sudden, our models want to give it some money, it gets some money, and we made a good deal of money in about 6 months. And then it started to say it's not really, it's going back to the way it was before. And I don't think we've traded it since. But that's kind of in theory how it can help kill those post-dictive problems, as well as operate under a principle that we think ties into the emotion, the emotional universal that we're dealing with.
And what allows you to do that is the fact that you're short term. You have many trades, many observations, unlike a longer term manager, where essentially if you were doing that and you were waiting for some level of profitability in the signals, you might actually end up being way too late because you have so few observations.
Correct. One of the other benefits that just came to mind, I would say benefits, but things that have really been beneficial to us, is taking this more deductive approach to research and not being so data dependent. Has enabled us to be able to analyze and look at a few adjustments post 08, particularly post 2010, when we had the worst year, the worst year I've ever had as a trader. We were down 9%. I don't think we've ever lost more than, I think we had a down 4 at some point prior to that. Everything other than that's been like at most down 1. But the problem for a lot of highly quantitative traders is that you get into this weird environment that we're in, and they don't have enough data to try to figure out how to trade it. I mean, and so until we get, what do we need to get 10 years into this kind of environment before you can, you can look at the data and say, oh, okay, based on how those markets are trading, this is how we're going to trade them. But since we're just trading principal, I can look at it and say, am I applying the principle? What's changed in the application? No different. I mean, you brought it up earlier about it wasn't that the theory changed. The way it was structured has changed, and you need to adapt to the structure. But the same philosophy, the same psychology is operating. And what's been going on, obviously, in the crisis has been the political intrusion in the marketplace. What we learned, with a bit of difficulty in 2010, because our drawdown occurred right during a time of QE2, the midterm elections, and there was one other big deal going on at the time. Again, they were all politically oriented, which created a certain type of noise that was particularly toxic for us. And it was very frustrating to me because in 2009, we had a little bit of a rough run in the beginning of 2009, but we still salvaged the year. We were up 5. I think everybody else was down 5 or I don't know, something like that.
Yeah, sure.
And so I thought, well, maybe this doesn't really mean anything. And I can sense and I can feel and I can taste and touch and smell that the influence on the markets here is more than I had anticipated. In 2010, it was obvious that it was more than I'd anticipated because we went into that downdraft. And what I had done in 2009 was create a small type of way to try to avoid what I was beginning to call bad volatility. Because volatility, what I think I'm getting from volatility is, it should be telling me something. Markets increase in volatility before they either reverse or before they really are going to take off. That's telling you something. It's a feedback loop, just like momentum tells you something, trend tells you something, everything tells you something if you're open to what it's trying to tell you. And there was no connection between the two. And the political intrusion, so the feedback loop for pretty much all types of systematic trading, particularly those that are relying on some of these universals, was getting blurred. So we get the volatility, but there'd be no movement after. You just get knocked in and out of a position and nothing will happen. And so I said, how do I, I'm not going to build a system that's designed to do something different than what we do. Perhaps my perception of what's going on is incorrect. And literally, it was one of those aha moments. I mean, it literally, from in 2010, in about a 1 week time period, it all came to me of what I was doing. I was battling the markets in the wrong way. I was doing, I think, what everybody else was doing at the time, which was thinking of that volatility as being bad, and trying to figure out how to avoid it, so that I can get the true signals. I can get the ones that are actually telling me, what the market wants to tell me.
Sure.
And I thought to myself, it occurred to me immediately, that is such the wrong way, at least for me, to think about the problem or to frame the problem. The market's behaving irrationally.
Sure.
Theoretically, it's impossible to create a filter to stop it because by definition, it will not repeat in the same fashion. In other words, if somebody goes every day and gets coffee and then throws it on the ground, you might think that that's silly. But if they do it every day, you don't think much about it. You think people are crazy when they do unpredictable things, and they you don't know what they're going to do. When they're going to walk outside with a garbage can, filled with goldfish or something. By nature, the irrationality side of it, the universality of that irrationality side pretty much says that you can't create a filter to stop it. But then I thought to myself, if it's actual volatility and it's movement, it is a reflection of human action. So what is it telling us? And then I began to realize that it's telling us the same thing from a political perspective rather than a market perspective.
Right.
And the way that I try to explain that to people is that we're looking at these momentum shifts in the marketplace. But we require very specific setups because we want to, in prospect theory, we want people to be under duress when we're doing our trading. And so it's very, very specific. We just don't simply trade momentum because momentum happens. We trade it when it's in a particular environment, under a particular setup, under very particular situations. But the marketplace, the way we explain that is that when a market begins to increase in momentum, to us, that's telling us that there's urgency in the marketplace. That people are less concerned about, the price that they execute. They're just concerned to execute. It's like get me in or get me out order. And so they're being emotionally impacted. They're not getting their price. They're just throwing the towel in, or they're having to adjust, or they misprice the market, or whatever. It's telling us that the people are doing things in a way that they wouldn't prefer to do them, but they're having to do them that way. So this momentum increase is a feedback loop, because if you're trading, for example, wheat, and you're watching the wheat market, And the movement in the wheat market is a sum total of all the people who are watching the wheat market, who know what's going on in wheat, who have ties to the cash, and you're watching it and you're doing it. And it's a feedback loop of everything all the market participants know about wheat. And so generally, when you get certain bits of momentum or volatility, it's significant because all those people together usually don't misprice the market so dramatically that it just creates chaos. That's not normally the way it works. There are mispricings, but they tend to be, small to medium, not gargantuan. Like, oh, geez, wheat really should be double the price, or maybe a small mispricing. But what happened when the government got involved is that now everybody's watching the wheat market, but it's no longer a feedback loop of the wheat market. It's a feedback loop of, what did Bernanke say?
Right.
What did so-and-so say? And then the wheat trader watches, the Fed announcement and then runs over and expresses himself in wheat.
Yeah.
The problem is that may or may not actually match the fundamentals of wheat.
Sure.
So as soon as the political thing fades away, the market reverts back. And so you're getting an impact on the market from a different feedback loop. However, it's psychological in nature. So it immediately occurred to me, what's the difference between the two? There is a difference, but how can I capture that difference?
Yeah. And
we developed a way to broaden, instead of pull back from political volatility, we decided to expand and accept it. And, since it took a year of very creative programming to get that kind of subjective idea in play in the marketplace, but we're up 20 last year and 10 the year before, and what most people would consider to be in brutally difficult short-term trading conditions. And I think it was mostly capturing the moves that are not normal. I mean, when a market moves, there were so many like 20% moves in the marketplace in 2013 that happened in like 9 to 12 trading days. But then they went right back. I mean, it was too short for trend followers to capture it because a market normally would never have that type of price movement because it would never have been so mispriced and then go back to what it was doing and then have it happen again. But it is a psychology in the marketplace that isn't too different from a feedback loop of a market, but it's a feedback loop of a different type, and it can be exploited.
So if I'm trying to understand what you're saying, clearly the norm would try and and would be to get some kind of follow through from the point of entry and to capture, a 2-day, 3-day move. But obviously what I've also observed, myself from the markets in the last few years is that certainly in some markets, maybe not all, but there really has been a lack of follow through, maybe because of the noise of the media and statements and this and that. So the changes that you made, and I'm just guessing here, but is that more to do with the fact that you don't just look for the follow through or the momentum in a direction, but actually now you're also trying to capture the mean reversion side of things when things don't work out?
Correct. We're casting a wider net to allow for the greater degree of variation and the amplitude of these price movements, because it doesn't take for the psychology in a market to we've always been an under 5-day trader with our we're rarely ever making it 5 days out, but usually 2 to 3. And the reason for that, which makes complete sense to us, is that's about all the time it takes for all the market participants to react either in favor of or to deny the movement has any legitimacy.
Right.
And so as the psychology rolls around the globe and everybody adjusts to the new price level due to the mispricing or what have you, or everybody having to exit a position. And so I've always been asked the question, well, if the market just keeps going, why don't you just hang on to it and ride it for another week or two if it's in the right direction? And the point is that we don't do that for two reasons. One is we're not looking to capture trend, and that's what that would be. But two, momentum can only exist generally in a short time frame, because for momentum to increase, it's got to be like, market's up 1%, the next day it needs to be up 2, the next day up 4. I mean, those aren't not exact numbers, but the point being is that it has to keep going, and it will exhaust itself literally within, for momentum to increase for 5 straight days is almost impossible. So the psychology behind the momentum, and then if it starts to wane, then it will cause you to reassess what you're doing. So for us, the momentum has to continue, but out of necessity, it's only going to go this far. Now, the problem is that that's the way it exists naturally in a natural feedback loop to a regular market. But the political feedback is a little bit different. because it has no tether. There's nothing that says that it can't change. So what happened? I mean, if there's a sudden adjustment of the price of wheat, pretty soon everybody can figure all the possible outcomes, and you can get that resolved within that 3-day time period. A lot of the markets that are being impacted by the Fed and by regulation and so forth, they're not tethered by that, so they have some very weird characteristics. They're too sharp of movement and too much of a retracement after the sharp movement for a trend follower to catch, but they're completely out of character for really short-term guys. Because that's not normal. I mean, if you get in and you get a move, you expect, if I buy on this little bit of a move, I'm going to capture, 10 ticks or something in the bond market, or maybe 20 ticks. You don't think you're going to capture like 4 handles. But if you get a sudden shock to the system,
sure.
and that's the way the markets are reacting. And so, how do you find a middle ground? I mean, it would it'd be like a 6-hour conversation to try to explain it, and but it can be done, and I think we've done it. But I know that everybody's always concerned about making adjustments to trades and making adjustments to your strategy, and I think everybody's been pleased with the adjustments we've made, because we haven't changed any models. We've changed how we implement the models. No parameter changes, no anything on that line. We've just lined them up differently on the table,
okay,
on how we throw it at the market and how we view time and how we view risk, and how everything works together. So it's worked out well. And we were having a good run prior to that, and a good run. We've had a good run since. I think we've beat the long and short-term averages 5 out of the last 6 years. So
sure.
On alpha generation, we've been okay. But I always challenge people, if you're concerned, do what I always say, which is look at our correlations. Our correlations haven't changed at all, and our correlations are not just the fact that we're non-correlated to everybody, every benchmark, manager, fund, strategy, market that you can find. It's that we have very specific negative correlations at extremes, which, that's the way if somebody can't, they can't, I don't explain it well enough for them to see how prospect theory and just decision-making under duress impacts our overall strategy. Then look at the data then.
Sure.
Because when other people are having rough times, that's when we ought to be making money, if we're doing what we say we're doing, and those correlations at the extremes haven't changed at all.
I mean, in trend following, many people actually say that position sizing is actually probably more important than the entry point and the exit point, because of the time frame. What would you say is the most important of those 3: entry, exit, position sizing, when it comes to short-term trading?
I can't speak for everybody in the short-term space, because I think a lot of people would probably disagree with me. For me, the entry level, whether you have some parameter that speeds it up or slows it down, and consequently the same thing on the exit. I could roll the dice on any of those things in my model. What makes the biggest difference is, when do you present yourself to the market to trade?
Right.
When, for us, since we are looking very specifically for certain things, if we, last year, like I said, we did, 1,700 round turns, and we make 20% net of all fees. The interesting aspect of it is that we're having the same profit per trade as a good year for a trend follower, and a lot of trend followers trade more round turns than that. So we're actually making more money per trade than most longer term traders, and we can only do that by being incredibly selective when we trade. And we may not get an order. We didn't have an order for a U.S. Treasury bond for the first 4 months of the year. I mean, what trader doesn't have an order for Treasury bonds?
Sure.
It's just, and that's the way we approach the world, and so it matters the most, and that's a good portion of what it was a continuum of an idea that we had been working on that really helped us out after we had a difficult year in 2010. It was one of those, I can't believe I didn't see this. I can't believe I can see this was a logical extension of what we're doing. It's just that when you never had to do it, because the markets never got that weird, you would never think about, all the things in life that you think that was an obvious solution to the problem. It's like, well, until the problem was made obvious, until you actually had to wrestle with the problem, you don't think about it.
Sure. How many models or setups, however you would describe it, do you run in the Sapphire program?
We have the same, what we call our, we've always used the terminology that we have, 2 strategies in the portfolio. One is directional momentum and one is mean reverting momentum.
Right.
And that, if I just stopped at that, that might describe, at least a dozen other short-term traders.
Right.
So obviously, even though that's the easiest way technically, it's like I don't even particularly prefer to be called a short-term trader because short-term is not a strategy; it's just a time frame.
Sure.
And what we do compared to other short-term traders is it'd be like putting a stock trader and a rental property. I mean, they're apples and oranges.
And also, in a sense, whether these setups, because we are dealing with human behavior, whether they're the same regardless of which markets, whether they apply to all markets.
They're the same for every market. We don't have any special anything for any one given market.
Okay.
We have as I said, the two strategies, but within those strategies, we have a variety of variations, and the variations are based upon different persistencies that we see in the marketplace. They're not there for any kind of serious diversification because they're not. We can get more diversification in other ways. For example, for us, it's as important, actually it's more important than the parameters of the model or even the particular setups as to what data are we analyzing. I mean, are we looking at 24-hour data? Are we looking for pit session? Are we looking for half of the pit session? Are we looking for the pit session plus 2 hours? We look at how we analyze data as being incredibly important because for us, the data has very specific feedback implications to what we're trying to find in the data.
Okay.
So, for example, for us, I know that some traders are very happy, to exit positions or to enter positions at certain hours that we would never consider doing it because we don't believe the market has the information we need. They're probably doing it for the exact opposite reason because the market's mispriced because it doesn't have the information.
Yeah.
That to give you a small idea how significant this is for us, we trade the Nikkei on the Simex and we trade the Nikkei Osaka contract. Other than the fact that one is 2 times the size of the other one, they're identical.
Sure.
However, we have different opening times and different closing times in those two markets that are not substantial, but they are different. At least, and we have no official open and close times that match anybody else's or any exchange or anything. We like I said, we build data to meet what we think makes sense. But just to show you how important that is, the two different Nikkeis, just having that small amount of difference, have I think a 0.27 correlation in their performance.
Wow.
So we do not have any problem at all getting non-correlation even out of the same market. We can trade multiple versions of the same market or multiple models of multiple versions. The question is why and how do you piece it together so that it makes sense with your theory and it's giving you what you need to know. So to answer your question, we make the model. We make every market as open to a potential 48 different individual models, half of which are directional and half of them are which mean reverting. But it's not like you get all those orders all the time. I mean, we have a whole process of weeding out, going to the strongest models and markets at the time that are giving us the greatest expression of what the psychology is at the moment.
I want to jump to a slightly different area of risk management because I noted that you have some very clear guidelines of what you expect in terms of drawdown. I noted that you said that I think 80% of your drawdown should be less than 10% and only 10 to 20% of your drawdown should be more than 10%. And you've, as far as I'm aware, that's exactly how it's been over a very long period of time. How do you know that that's going to be the case? Because this is something that I saw a very, very long time ago. This is not something in some of your recent information. But the fact is, many, many, many years later, this is still the case. And in an inherently volatile, uncertain, unpredictable world, it's pretty good to be able to be so precise and delivering that.
Well, some things we feel that we're good at understanding the distribution of our own trades, and that is like, we're pretty comfortable in telling potential clients, here's what it's going to look like correlation-wise. And usually you get the quick nod. It's like, okay, yeah, we know you're non-correlated, move on to the next thing. But to me, non-correlation is great right up until it correlates. But we just don't, it's so intrinsic in what we do. So we can pretty much guarantee you that our correlations are going to be a certain way, and they're going to be strongly negative, to difficulties and other strategies and so forth. And we've run so many studies, and we, even with the global financial program, because it ran with the same philosophy, we said that back in 94, 95, 96, we ran studies to show it. It's been consistent for the entire time period. And because we're very specific about what we're trying to tackle in the marketplace, the risk bucket that we're drinking from hasn't changed. And we know how that reacts to everybody else out there, how it reacts to the stock market, how it reacts to hedge funds, how it reacts to long and short term. So we're pretty comfortable with that. On the risk side, I feel the same way, only because when you're plugged into kind of a natural law, universal claim as it pertains to your trading strategy, it makes it very difficult to lose 80%. I mean, you really have to over-engineer. You really have to go out of your way. And if that's the case, usually you pretty quickly know that you're missing an ingredient somewhere, some structure of a market changed, or you've misapplied the principle. And it doesn't mean that if you're really over-optimizing stuff, or you're really heavily data dependent, and the data changes, it can be horrifying. And you can, I think one of the reasons why the CTA indices, which are a reasonable reflection of the whole industry going back to 1980, not only have a very competitive rate of return, it's like the lowest volatility of all asset classes. And you could say, oh, there's survivorship bias and there's this and that. But the point being is, if that's really a collection kind of that of the bulk of those traders going after this universal, I think that it says something also about about how the drawdown profile can be contained. And if you were to ask, what is that going to look like, 20 years from now, the CTA index, I'd say it probably is going to have the same drawdown profile. I don't think it's going to suddenly start going down 40% every other year, or be as erratic as other things are. For us, we set that. We wrote about it back in the early 90s. That 80% of our drawdowns in the single digits, and 20% are going to go somewhere between. Most of that other 20% are going to be contained in under 15. But we know for certain that a few are going to get out there closer to the 20. And if we trade long enough, we're going to breach that easily. I mean, it's just going to. Your biggest drawdown is theoretically always in front of you, but it is kind of ironic. And I've said this to people, and I'm surprised that you brought it up, because rarely do I hear people bring it up, because it's one of the things that I'm very proud of, the fact that I think we, now after 20 years, I can say we get the nature of risk as it applies to what we're doing. It doesn't guarantee, X, Y, Z, but as much as you can kind of put something in a box and say, I think I understand what's going on here, and it ends up being, in our entire, combine the two programs, we've had only, 2 drawdowns that have materially gone past that 10. I think we probably maybe bumped off 11 or something 1 or 2 times in there in that mix. But it would be about exactly the breakdown that I said. 80% of them did stay in the single digits. And so we've been able to hold that. Even when we've gotten, we got a little off track focus in the early 2000s, where we flatlined there a couple of years and just had some not what we're accustomed to in terms of returns. And even in 2010, when it still didn't. It pushed us down, but we were able to come back and make new equity highs within a reasonable time period.
Sure. Yeah, no, it's almost kind of ironic that this is clearly something that is a very strong side to your strategy and your business. And it's kind of ironic thinking of that when you go back to the story you started out telling about your near-death experiences in the risk management side. So you clearly learned something from these horrifying events very early on. That's for sure.
You have to stay in the game.
Yeah, exactly. Now, just out of curiosity, we talk about drawdowns here. We talk about, although they're not, at least in my mind, and compared with, say, equities, a 10, 15, 17% drawdown is obviously not, something to worry too much about. But investors do worry about drawdowns and managers as well. And it is an emotional roller coaster to go through these experiences. But given your philosophical background, I wonder, do you take a completely different approach, when in terms of the emotional side of a drawdown, if I can put it like that?
Well, I certainly try to. I think overall, I'm, at least from what most people in the office tell me, I'm pretty stoic about it. I wasn't, in the early years, there was a lot of fear. And it's not that I don't ever have any fear when we have a drawdown. It's not at all destabilizing, or it's anytime, and you spend most of your time not on equity highs. So I have in my mind mental alert levels that are just roughly down every 5%, to where I want to go through and I want to check certain things because I have certain expectations. Right. I've also learned the hard way that you can't get to a 20% drawdown without it first being 5. And even though a lot of 5% drawdowns don't mean anything, they're random. It's just part of the distribution of the P&L, profits and losses, of the trades going forward. I do know that at times where I've realized I could have, should have, would have, or there were a few things that were not where they should have been. The world, the way our application of what we're doing was less than optimal, and it could have been more optimal. That appears early. I'm a big believer in the trends of your internal numbers, not the internal numbers themselves. I could care less about half the numbers that people ask me about that they think are significant. To me, the question are the trends of the numbers, and because they often are anticipatory of something that's going in a certain direction. And when you get enough lined up, it can hopefully be something that will teach you to get on track before it gets too far out of control, because it's very, very difficult to recover. Once you get down past that 20% level, not only does it get difficult to recover, but if it's at down 25 or down 30, that you're making amazingly different adjustments to your models, you're going to also miss out on that natural mean reversion of your performance. So you find yourself in a very difficult spot. So you don't want to get down too far in the hole, but you also would like to see the process possibly unfolding before it gets there. And sometimes it can look like it at times, and then it's not the case. But more times than not, the solution is before you, but you don't see it because sometimes it's masked. Like you could be making money every month, and if a few things were better, positioned, maybe you would have made more money. But you're just happy that you made money, and maybe somebody else didn't make money. And so you don't dig through the details and say, well, gee, I was making money because XYZ markets were just awesome, but these 3 models over here are deteriorating or something's happening. It was just masked by the good run. So trying to do metrics that show us the kind of that the internals, if you want to call them that, or some things that are not quite focused correctly, has always been a huge help for us getting off the track too much.
Do you think investors spend too much time trying to completely dissect drawdowns and actually not so much the good runs, meaning really understand why you made money as much as trying to understand why you lost money?
Yes, they spend a lot of time trying to give color to whatever they're transmitting on to somebody else. And quite often in the process of collecting information, most of which I don't think is very relevant, they often, I think, miss out on some of the what I would call obvious questions. Or and even if they don't have the question, you can tell quite often from somebody what they think is driving the P&L. And it leads to all kinds of confusion and at times I think bad decision making. I mean, you see this guy is making money and this guy isn't making money. Making money doesn't make you a good manager. Over time it does, but in the short run, you have 2 trend followers and one made money last year. It just simply maybe his portfolio allocation to the one market sector that happened to be more, which is completely random. And so you fire the one guy and you give some more money to this guy. Well, then the next year he's not going to be so lucky of being, having more risk in the best sector. And you get a lot of trading traders and not asking the real questions of what's really driving the differences in their performance. Is it something that's intrinsic to the strategy itself, or is it just simply portfolio allocation? Is it because they're more highly levered? There's a variety of things that, it doesn't take much to pull that out of the data. I mean, we're empiricists after the fact in our office because we love to look at things after the fact because 99.9% of the time you generally ought to see in reality what really is true. You can be fooled sometimes. There are things, there's exceptions to rules, but over time. And so when you look at somebody and they say, hey, we're a short-term trader, and then I say, but why do you correlate to the long-term trading index by 0.67? I mean, obviously where you're getting your alpha has a huge overlap with the trend guys. and you can learn so much about what somebody is actually doing, where their exposure is, what sectors, by being reasonably smart about how to dissect the data. That will tell you a lot more than probably 98 out of 100 of the questions that you would ask a trader. You can see, and then once you see that, it's a lot easier to say, is what this person's saying, does it match with what they're doing?
Tell me a little bit about, before we go to sort of the last section, I just want to touch a little bit about research, because clearly the way you approach trading is quite different. So I would imagine the way you approach research is quite different. What would you say is sort of the key things that people should understand from your research process that helps set you apart?
The easiest way to understand our differences is by trying to understand why we trade the way we trade in the first place. And when we talk about that our approach is driven, sometimes when people hear you're short term and you have directional mean reverting, they pretty much throw you in the basket with everybody else. And it's not that I don't like being in the basket. There are a lot of fine traders there. It's just, it's not what we do. And unfortunately, it's become a lot of graduate level classes on behavioral finance in the last 5, 6, 7, 8 years, but it's still a lot of the terms, and still everybody, if I use old school language, which I used to do in the 90s because people didn't understand prospect theory, just say fear, greed, and money flow.
Sure.
Things that people can relate to, which is no different than, and everybody knows the pain. So when I dress it up in the terminology, but then I show how we in our research process tie out these concepts like, loss aversion, and how behavioral finance talks about, people always mistake that the joy of, winning $10 is equal to the pain of losing $10. And, loss aversion in prospect theory shows that people feel the pain of loss, much greater than the pain of gain, which any trader after you trade realizes that. Or if you have, clients in a fund, or if a client comes to me and says, hey, go ahead and trade. Yeah, we can take 20% drawdown. Yeah. Well, as soon as they leave your office, you're like, okay, they can take maybe 10. Yeah. Or maybe 7, because according to research, it's about 2.6 or something is the pain to gain type situation. Sure. So most people they're focusing on it's like when I did my early career, I was focusing on those profits and didn't realize that if the pain was coming, it would be so intense, and it can really be destabilizing. And so when you have even professionals miscalculating their own risk tolerance in all sectors of the economy and all things, not just trading just intensifies it. And then you combine that with other principles like, self-attribution bias, the Lake Wobegon effect, where all kids are above average. That every professional in the financial world thinks they're above average. Well, we can't all be above average. Sure. We definitely, attribute to ourselves and our own opinions much more than probably objectively would be deserved. And you throw in their anchoring and confirmation bias and so forth, and you see when you put these together how dangerous it becomes. And so the point is, when we're focusing on this, we're focusing on capturing in the marketplace the unwinding of that, and that's what's driving the correlations, and it's always going to be there unless people suddenly the decision making and the human nature suddenly does a 180-degree turn from the last 10,000 years of known history, which we don't believe it will. So as long as we can stay on task in terms of adapting to where the risk transfer is going on, where the excitement of the human drama and play is optimally able to be observed and watched. And that's really why, it's funny, because that's where behavioral finance, it's why it is behavioral finance. It didn't start as behavioral finance. It started, studying this, and they realized that they can more clearly understand the decision-making process when people are under duress, or as, Kahneman says, under risk. And that intensifies it so that it's easier to see the bad decision. If it's just a little minor thing and on. But so when you start doing these experiments, they started, making them more financially significant, more about X, Y, and Z. And then it worked right into the financial markets, because what's more stressful than leverage with a lot of money, your career's on the stake, and the market's closing in an hour, you got to make a decision. There's no way out. You don't get to, if you're fighting with your wife, or if you've got something else going on that could cause you to impair your judgment, you have time to work it out. You can put it on hold. You can wait till next week. In almost any other profession, you can put it off for a month. You can't here, so it makes a perfect laboratory to show how these principles operate that, traders 100 years ago, the good ones anyway, were able to discover and understand and utilize. Now it's just a more formal way of describing it. So trying to get people to see exactly what it is we're doing so that the expectations, there's nothing worse than having misplaced expectations one way or the other in a financial relationship. It's like, here's what we do. This is all we do. I mean, we're not, and so, when somebody says to you, why did you, lose money in 2010? Nobody lost money in 2010. Every fund I owned was up. My hedge funds, my bond funds, my stock funds, my CTAs, every single thing in the universe was up. What's wrong with you? And it's like, well, when we lose money, it's because nobody's getting beaten up and providing us the opportunity to take the cash out of their pocket because they've misallocated or misjudged or whatever. So it's like our worst month, our worst year, our worst day or quarter, all are times when every other sector has made money. And so we're going to hurt you at some point. The point is, it's going to be a time period when, it's like 2013, the first quarter. We were down 9 in the first quarter. Every other strategy that you could possibly imagine was up.
Yeah. I mean, it's quite interesting, actually, because it would appear to me, at least, that in the last, 5-10 years, the CTA industry has clearly shifted towards European managers. And I think they certainly present themselves and probably structure themselves as with a much more scientific approach to research and trading. But it's quite interesting when you talk about the way you've described, your approach today, because people coming to do some level of due diligence, I would think that it's much harder for them to understand the science behind what a lot of these very quant-driven funds are doing, and obviously the inside of all the algorithms, whilst your approach is actually, to a certain extent, much easier to explain because it's based on human behavior, which we all know, even though we didn't study it. We all know what pain feels like. We all know what, gain feels like. It's just quite interesting that money and investors tend to favor the more opaque science rather than the more sort of human nature. Maybe it's not sexy enough to say that it's based on human behavior. I don't know.
I'm sure that's part of it. I think that if we right now had $5 billion under management, it would be viewed differently. Post-crisis, most of the money in the CTA world was raised prior to the crisis. I mean, how many CTAs have gone from 0 to X billion post-crisis? Not too many. And the ones that are in the billions, most of that, they were at equal to or higher numbers before the crisis. Yeah. The protective mode at the post-crisis time period has been one of such caution in addition to having the poor performance and so forth, that it's made it very difficult for anybody, even the European managers, to raise money. Many of them have lost assets over the last 4 or 5 years. But I do think, and I agree with you, said that there is a perception that there's a bit more of a scientific edge to European managers, and I think that that some of that is because most of the managers have been around from 2000 forward. And to me, the 2000, the first kind of real intrusion in the marketplace was, Greenspan, long-term capital. But then it went right back to the spigot in 2000, and the Fed has been tinkering since 2000 with interest rates. They lowered them dramatically, then they picked them up in the mid-2000s, and then quickly, in the late, and then back down again to zero for the last 6 years. But in that type of environment, at least as it pertains to trend following, which is, the maximum profits are going to be made basically in fat tail hedging, and the Fed has suppressed that, and so strategies that are trying to game, but they're spending all their time gaming around the trend, which has become necessary because the trends have been diminished to a certain extent, or become noisier to a certain extent because of a lot of these other factors. There is one other factor, though, that I guess it's probably my own personal observation, having done a lot of business in Europe in the 90s and in other countries. In the 90s, when I was spending a lot of time in London and Paris and Geneva and Zurich and doing the whole run all the time, there were just very few CTAs. And the reason that I went to Europe to get money was because in the U.S., even though managed futures kind of started here, and the futures markets here have been around for 100 years, the tax laws in the U.S. are horrible for being an investor in a futures fund, because we can't invest offshore like the rest of the world can. So if you invested in an LP here in the States, you pay tax at the end of the year. You pay your managers 20%, and then you pay Uncle Sam a big chunk of the profits, and then they might go away. And it's like, and there are other things that they don't let you deduct, and it's not very friendly. Where if you're going to invest in the Cayman Islands or Bermuda or Bahamas or whatever, as a European or Canadian or whatever, so the money came, even though the U.S. has always been market oriented and speculative, it just was not very favorable. So I think once Europe began to develop their own CTAs, I think European institutions are very pleased and thankful and happy to go in their own backyard,
right,
and prefer to go in their own backyard as opposed to having to come, over to the U.S. all the time and so forth. I think it's easier to get through investment committees. It's it's just easier for everybody. So
sure.
I'm not saying they haven't deserved it. They have done many of them have done very, very well, and are excellent organizations and so forth. But there's always more to the story.
Sure. Last section I want to jump into, and I only got a few more questions that I want to touch upon because we have already taken a lot of your time. But I call it general and fun, and I know you've actually shared a lot of personal stories, which has been quite fun and interesting. But I want to ask you whether you can think of some kind of personal habit that you might have that you think actually has helped in your success, something that you might do on a regular basis that you think actually has been beneficial.
There's a load of things. To smush them all together, to try to
sure,
put it in a time period, the commonality of the things that I think are really beneficial to me are, shall we say, downtime, more specifically alone time, time to think, time to recollect, to read, think about life, trading, everything from religion to politics to whatever. I get very cranky if I don't have some time to decompress in that regard and think about things. And everybody who that I know of that has some kind of a downtime or alone time, usually has some of their own routines that they want to do, and I do as well. That are some of them are personal and so forth. But that to me is very important. I have to cool the jets a little bit.
Sure.
and at times I've been able to, because when your job is one of your hobbies and probably your biggest hobby, it's very hard to, and it happens to be turned on 24 hours a day. It is hard to. It takes effort to do other things, and I used to do them like some of the weird things about me. I always have unusual hobbies like like magic. We've already discussed.
Sure.
Sleight of hand. Also juggling. I used to juggle in my office all the time. It would help me think. It's like it's just enough of a distraction to not be distracted by things that aren't important.
Right.
Somehow it kind of cleared a channel path, and so I do that. And then I also taught myself to ride a unicycle when I was little. But I never brought that into the office. But just kind of these, it was always trying to find these challenging things that, used to do the Rubik's Cube and see how fast you can solve it. It was the problem solving, doing things that, it's like when I got involved in trading, it was like, here's the thing that's, everybody says, 90% plus get wiped out and they can't survive. And so it's like, hey, that's the perfect thing.
Yeah.
You want to do something that just to challenge yourself. And so, over time, I realized that I when your schedule finally gets, that's one of the reasons why I'm not, anxious to move back to a city, because it'll just fuel my desire to go around, 24/7, as opposed to, I'll go home today and I'll, probably go sit out on my dock and look out at the water and, who knows, have a cigar and sit and think for an hour. And
Sure.
That kind of downtime is just magical to me. And,
Sure.
and my wife always jokes with me about this because, when she says, well, I really have this task I would like you to do. And to me, the sitting isn't, relaxation. It's actually work, because
Sure.
it's a work to, it not only helps work, but it's part of the process of how everything, the glue stays together. And I have some of my 80%, 90% of all my best trading ideas, thoughts, have come out of those time periods. They never come when I'm sitting in front of a computer. They never come from looking at a stack of data outputs and printouts, and that's actually toxic for me. That doesn't solve anything.
What do you think actually, what's the hardest about the job you do as a fund manager, and what do you find the hardest?
It's the bigger picture of it's that it's just not trading. I mean, if it were just trading, it's one thing when you're managing expectations of clients and of employees, and you're also juggling around with future obligations that you never know what to expect X, Y, and after I didn't know it when I first started the business. And while I was in Chicago, being with my partner, and my partner handled all the stuff within his firm. And so when I left to come to Michigan, I, basically really took over the role of CEO, even though I just had it in title prior to that. And I realized how much I didn't know about running things. And more importantly, how much, I think at that point, maybe we had 23 employees or something, and how much you impact people's lives. And this is their career, and it's important to them. And trying to communicate to them and be able to manage a relationship and productivity and expectations and so forth, and without ever having done that before, it was quite a learning curve for me. And since that time period, I've learned a lot. After a while, you learn how to deal with different situations, and no different than dealing with children or dealing with personal relationships. Only time helps you get through it, but that's the biggest challenge. But it's always, I can talk myself out of any market fear, but I can't. When you have employees or clients, and they don't see things the way that you do, and you've got to realize it's at the end of the day, it's a service business. Yeah. And so at times your hands are tied. You can't do maybe what you want to do, or so.
True, very true. Now, I always ask people whether there is a fun fact that they can share, and you've actually shared quite a few that but maybe there's still one left that maybe not so many maybe that not so many people know about you, even those who are pretty close to you. Is there anything that you can think of that's left in the box, so to speak?
Most of it has to do with I'll share one. This is kind of weird and outside the box. But maybe there's a tie-in, but I just don't want anybody to take that I am, thinking that anybody else should do what I do. Just like I don't max out your credit cards to trade futures. Yeah. And don't, I've got a whole list of things not to do. But because I have such a core central belief system about the nature of reality, and because of studying philosophy and theology and psychology and these different things, you get to the point where ideas they matter to you a lot, and you're very unhappy with unresolved thoughts in your head, and so you try to figure out what you want to do and how you want to do it, and at times that process can be, shall we say, painful for people around you. So perhaps an unusual tidbit about me that, in the big scheme of things, is not really perhaps relevant, but to me it's relevant because it also plays such a role in a thought process, is that back before I started Dominion, as I was studying philosophy and all these types of things, I became so enamored with natural law and the classics and different things that it started to change my thinking process of how I viewed history and time and all kinds of stuff. And to make a long story short, I did something that was very difficult for my family. I was raised a staunch conservative Calvinist. I decided that I was going to convert to Catholicism because of natural law, and I love the scholastics. I love their Aquinas' interpretation of Aristotle. And let's just say that had a monstrous ripple effect with extended family, your family, got things resolved with my wife. But, at the end of the day, ideas have consequences. Yeah. And so often, I keep reminding that when we talk research in the office here, it's like, we're all talking ideas. Remember, all these ideas have consequences, and you need to tie these things out between cause and effect. And what is, who's driving, what is the tail wagging the dog here, trying to understand these principles of, non-contradiction, causality, and sense perception, which are kind of the core elements of, developing a natural law theory a priori. Don't forget these, and also don't be afraid to go where they might take you, and they may take you in places that you never thought. I mean, if you'd asked me, at any time growing up, if I would be doing the things that I'm doing, believing the things that I believe, and a lot of them have been very painful and difficult transitionary phases. But the common theme is, and that's the only thing I can recommend anybody is follow your ideas and take your ideas to those logical extremes to see whether they're worth following, to see if you really want to do something. And it's easy to sit around and complain or say, I'd like to do this, do that, and tying it together is, as Mises says, economics is human action. It's acting, and all action is toward an end, as Aristotle makes clear. And that, in a sense, is really, truly being human. So,
yeah, no, it's interesting, and it kind of ties in with my last question, and maybe not my second last question, maybe you kind of answer it, because it sounds to me like, what you've done is and I was trying to think of some kind of philosophical question to ask you, and my limited knowledge in that word, but it almost sounds to me that what Alan Watts said in some of his work was really, if money was no object, what would you really enjoy spending your life doing? And it almost sounds to me like that's something you asked yourself at a very young age.
Yeah, I don't think I was ever too concerned about the money until I started making some, and then I realized I could be just a subject to a lot of bad decision making as anybody else.
Yeah.
But no, exactly. You find out what you love, and I think so much more. I think when you're not really self-aware or self-critical, sometimes you really don't even know what it is you love. I mean, it's a process to really squeeze it out of yourself to say, I think I like this or I think I like that, but what is it really you can't live without, and what is it that's really important to you? And it takes a while just to come down to even getting to the point where you can resolve to follow that path and follow wherever it goes.
Sure. No, absolutely. Now, Scott, my last question, we touched upon it a little bit earlier on, talking about what investors are missing, what they're not asking when they come and see people like yourself, and so on and so forth. So I have to be critical of myself as well and ask you, what have I missed today? What are the questions that I should have asked you that I didn't?
Well, I think we covered most of what I would think are the important ones. I'm sure that I'll go through multiple hour meetings where I will explain prospect theory, and then they'll want to get into mathematics, and then they want to see what kind of computers I have in my server room. And that's fine. I know they have to look at kick all the tires and everything, but it's always amazing to me. It's the dog that didn't bark type thing.
Sure.
It's and to me, the very, very simple and straightforward. And I think for the most part we've covered it here today. But the questions that I would always ask anybody is, why do you make money, and why will you continue to make money? And those two will very clearly steer you into what actually is the inefficiency. Because there's a huge difference between, as we said before, the kind of the natural law and universal claims as opposed to the particulars. You can be very good at figuring out that the last X number of unemployment reports, for 2 hours after that the market did X, Y, Z, and that's how we're going to trade. And you find all these small inefficiencies, and then as soon as they go away, you find new ones. And so if you answer that question, you say, why do I make money, and how am I going to continue? I'm going to continue because I'm smarter than everybody else, and I have faster computers and a better research staff. And so depending upon what the manager is saying is what they do, I think those two things, why do you make money and why will you continue, pretty much will force the hand. And it's not, you're not going to make money because of a formula. I mean, you use formulas, but that's not why you make money.
Exactly.
And so, being very specific about, what that question is, I think those two questions, for me, they would be very important. And after somebody answered that, and I looked at the data of what they have done with it, I think you can tie it up pretty quickly.
Yeah.
The rest of it's just personal, integrity type evaluation.
Sure. No, I agree, and I think that we certainly have, been very fortunate to hear a lot about the why today. And as long as you feel that I've done yourself and Dominion justice, then I think that's a good place to end. But before we finish our conversation, perhaps you could let the listeners know where they can reach out to you and learn more about yourself and Dominion.
Certainly. Probably the easiest is to go to our webpage, which is www.domcap.com. That's domcap.com. And the information there will give you a phone number, address, email, contact information, and so forth on how to get in touch with us. And you'd be most likely getting in touch with Joe Vanderbosch, who is in charge of our client services.
That's great stuff. And of course, also I can say to our listeners that you can find all the show notes on the webpage, toptradersunplugged.com, and I'll link a lot of the details from our conversation today with Scott there. And I also want to say to the listeners that the emails you receive from me, in there is a way to thank Scott actually for his time today by clicking on a little link, and I would certainly encourage everyone to do that. And for sure, let me be the first, Scott, to say thank you so much for all your time, all your insights, your passions, and your vulnerability in telling stories that are, of course, very personal. It's been amazing conversation. I really appreciate this transparency and just that you've shared so many great stories today.
Thanks. I've enjoyed it, Niels.
Fantastic. And I hope we can connect at a later date and find out how the great work is coming on. So thank you so much, Scott, and take care.
Thanks.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.